Good afternoon, everyone, and a very warm welcome to today's webinar, Transfer Pricing Post-Budget 2026 Strategic Impact and Compliance Shift. Transfer pricing is no longer just about compliance. It's increasingly becoming a strategic lever for businesses. With substantial changes introduced in Budget 2026 and the final income tax rule, we anticipate a clear shift in how organizations will need to approach documentation, risk management, and cross-border transaction going forward. To help us decode these developments, we have with us a fantastic panel of experts from ASA and Associates. We are joined by Sunil Arora, National Head Taxation, who bring deep expertise in handling complex transfer pricing matter and advising large multinational clients. We also have Ashwath Pai, Executive Partner Taxation, with extensive experience in cross-border structuring and strategic tax advisory. And joining them is Priyanka Ahuja, Senior Manager Taxation, who works closely on transfer pricing compliance and brings a strong practical perspective on implementation challenges. In today's session, we'll move beyond just understanding the changes. We'll focus on what they actually mean for businesses, where the risks lie, and how organizations can prepare proactively. We will also have a Q&A towards the end of the session. Time permitting, please feel free to share your questions in the chat box and we will take it up at the end. With that, let's get started. Sunil, may I invite you to kick off the discussion? Thank you.
Thank you. Thank you, Shweta. Hello, everyone. Hello, friends. I think Shweta did mention why we're having this session today. I think transfer pricing today holds a great importance given the recent changes that have been made in the last budget. And then what we saw that the new rules for the new Income Tax Act 2025 came out. And that had a lot to discuss on transfer pricing as well. So we thought it would be very useful for our clients, for our audience to understand what are these changes and how it impacts their reporting requirements, their transfer pricing strategies in real terms, in business terms. Friends, I think transfer pricing is amongst the laws that has lived a significant life. It was introduced in 2001 and has evolved quite a bit. The initial changes that were made to the legislation were more compliance oriented, more fundamental. But then, as the law evolved, there were more quality changes introduced, more strategic changes introduced, more risk based, substance based changes introduced. So let's try and see a quick timeline of how the law has evolved. 2001, as you know, the law was brought into practice. Uh, for about 10 years, first 10, 11 years, I think the law sort of, everybody was trying to discover how this law should be practiced, both from the administrators, executives perspective and the tax practitioners perspective. Uh, 2012 was the one when the first big change came, more on the compliance side, where the legislator felt that specified domestic transactions, SDT, should also get covered under the compliance reporting requirements. What they also introduced was a framework to decide transactions under the APAs, Advanced Pricing Agreements. Uh, 2013, immediately after, they introduced a law saying that we want to get into a safe harbor. We want to introduce a safe harbor provision. Safe harbor essentially means provision wherein you get a framework where if there are transactions of a particular nature, they can be accepted without any further questioning. Again, very specified to some transactions, some businesses, some situations. Immediately thereafter, you see the timeline 2012, 13, 14. The scope of APAs was extended and a rollback was allowed. So APAs that were allowed for 5 years were then allowed with a rollback provision for a total of 9 years. A very welcome move. Same year, the government introduced a very important change where they spoke about the range concept. And they also allowed you to use multiple year data. Uh, Again, in a short span of 2 years, the government went ahead and adopted the suggestions of Action Plan 13, the BEPS Action Plan 13, and introduced CBCR regulations, CBCR reporting, and the master file reporting. 2017, again, very important secondary adjustment. The government said we don't want to do any more notional adjustments. We want the cash on account of transfer pricing adjustments brought into India. 2017, thin cap provisions. There was a cap applied of 30% under Section 94B. After that, there have been no significant changes, although the law kept evolving by way of multiple judgments on multiple complex issues. 2026, my friends, has been uh, a revolution for us. The changes that have been made in the budget and the rules that we see now are much more progressive than we had ever imagined, or let's say this is the second life for the transfer pricing regulation. What have they done? First of all, they've said that the safe harbor regulations, specifically for the IT sector, what they've done is, if you are falling in the IT sector, you're doing different sort of activities. They said we are going to bundle you as an IT service provider, and we are going to give you a much lower rate of cost plus at 15.5%, which again is much lower than even what was agreed in a lot of APAs that India signed, more of them with the US, both under the bilateral discussions and unilateral discussions. So that was, I think, almost a home run for IT service providers. Then a second change that was introduced was to say that if you are willing to do a unilateral APA, unilateral is a one-sided or one-country APA, we will make sure that we conclude this in 2 years, 24 months. Very bold move, but again, a very welcome move. The extension of 6 months only applies if the taxpayer wants it, but generally, let's say they will conclude it in 2 months, 2 years, or 26, 27 months, give or take. Uh, what they've also done is in the rules that have been brought out, they've said the reporting needs to be exhaustive, far, far more exhaustive and constructive as against what we are used to right now. So a complete change in the way the government is looking at implementing these provisions. And on the other hand, what the government expects in terms of reporting requirements from the taxpayers. I will call it very progressive, but again, the government is trying to balance it with the reporting requirements that they want to bring into change. So, what are the key impact areas that must be noted? Of course, our experts are going to talk about it in more detail. But just for your eyes, just give me the next slide, please. Key impact areas. One issue that I've been again talking about. We've written some white papers on this also. Uh, in the past, there have been a lot of innovation R&D centers that have been set up in India. Now, and earlier these were all engineering centers. These were all back offices. These were all development centers. But now they have evolved into something that perhaps does more than just development, more than just back office activities. And therefore, the companies are preferring to call them innovation centers. Now, one of the conditions that will qualify you for a 15.5% lower rate, provided, of course, you meet other conditions, is that you should be the criteria should be that you should be adding insignificant risk into the whole supply chain of the business. Now, whether by claiming that you've set up an innovation center in India, now, whether if you create IP, you certainly are out of this race of a 15.5% rate. But even if you don't have an IP, but you add significant value in the garb of innovation, do you actually qualify for this 15.5% rate or not? I'm sure Ashwath is going to touch upon this topic. Ashwath, if you can explain your viewpoint when you present your slides, that will be very useful. The other point is about APA timelines. APA, my friends, as I said, has been very useful. The government has leveraged, taxpayers, governments have leveraged APAs to resolve a lot of complex transactions. We represent a lot of US companies. We represent a lot of Japanese companies. Especially on the US side, there have been a lot of bilateral APAs, both bilateral and unilateral APAs. On the Japan side, again, there have been a lot of bilateral, also unilateral. Mainly Sogo Shoshat or the trading companies have gone into these APAs. What has the government done this time? They've said you can conclude a unilateral APA in a period of 2 years. Now, 2 years, as I said, could be up to 30 months if you were to add 6 months that the taxpayer opts for. Uh, Today, my friends, the existing average time to conclude a unilateral APA is between 40 to 43, 42 to 43 months. That's close to 3.5, 4 years. Now, if you have an option to conclude APA in 2 years, the only term I have for this is a true game changer. I think if you are somebody who qualifies for an APA, who is not falling under the safe harbor rules, and this is something that you must do. I think you must take this opportunity, get down to do a unilateral APA, and avail this 2 years timeline that the government is offering. I think it's a home run. Uh, but uh, but again, as I said, they balanced it very well. On one hand, they have given you a lot of leverage, a lot of open mindset, a lot of progressive provisions. But the rules that we see right now, the new rules that are there are two new forms that have been introduced: Form 49 and 48. Essentially, Form 48 replaces the existing Form 3CEB, the compliance certificate. Now, what they're seeking, my friends, I think it's a very important part of this discussion with which our experts, Ashwath and Priyanka, will touch upon. They are now seeking granular details for every business arrangement that you make. And by granular, I mean a lot of details that used to only appear in your transfer pricing studies, sometimes not even in the transfer pricing studies. Sometimes you used to disclose these details. This the extent of details only at the time of transfer pricing assessments. So if you have a royalty agreement, the rates of the royalty agreements, the date, if you are doing a benchmarking, what is the percentile? What are the terms and conditions of any agreement that you enter? Restructuring agreements, anything and everything you have to commit in the form, you have to write there. And again, this is something that you can't change later. Your benchmarking approach, whether today you are applying a combined versus individual benchmarking approach, a transaction wise approach, something that you have to declare. So you are today in a situation where if you if you comply under the new guidelines, the new rules, uh, you are basically committing to anything and everything that you have to do in your transfer pricing study, transfer pricing reporting, and this is something that you cannot do later. So you have to do contemporaneous documentation in real terms today. Uh, uh, Also, please note the fact that these new reporting requirements equally apply to your overseas affiliates. Ashwath, Priyanka, if you can throw some light on this also. So I think with these opening remarks, I'd like to hand it over to our experts, Ashwath, Priyanka. Please take it over and I think discuss more details on the subject that we have at hand. Thank you.
Sure. Thanks, Sunil, for that brief introduction and for setting the tone for the kind of changes which we are looking at now. Now we'll try to do a bit of a deep dive into the changes which have been announced. So there have been multiple changes since the Income Tax Act itself has been overhauled. From the 1961 Act, we have moved to the 2025 Act, and along with that, the rules have also undergone a significant change. So while there are many, say, minute changes which have happened, in today's webinar, we are trying to cover the major changes which we believe will have a lot of impact on companies operating in India to whom transfer pricing applies. So there are two key aspects which we'll be covering. One is the safe harbor rules for IT services companies, which has been a major budget announcement which has been taken up very positively by the IT service companies. And second thing is, as part of the rules, the erstwhile Form 3CB has been completely overhauled by introducing Form 48. And while we saw the draft form which was released, by that time itself, we realized that the government now doesn't want a high level summary of transactions. They want much more granular details to be voluntarily provided by the taxpayers themselves rather than being provided in an assessment where the TPO asks for it. So I think we will look at these changes in a much more detailed manner as later in the presentation. But we'll start off with the high level summary. So what are we covering today? Like I mentioned, we will cover some aspects of the safe harbor rules, how the categories have been consolidated for IT services, how the margins have been rationalized, the eligibility criteria. While the eligibility criteria is still more or less the same, But I think this will be very critical for someone who, after the reduced margins, is looking at opting for the safe harbor regime. The process and compliance, how from a manual process it has become electronic now for IT services category. And a new category has been introduced for data center services, which we will briefly discuss later during the presentation. Form 48, like we have mentioned, has undergone a significant change. Now there is transaction level reporting. So earlier it used to be majorly centered around the parties who are involved, what are the high level transactions and what is the method, and basically whether the auditor is satisfied whether the transactions are meeting the ALP criteria. But now there is a lot of transaction level reporting which will happen and not high level summaries. Enhanced benchmarking disclosure. So benchmarking, which used to be majorly a part of the TP study, will now be reflected in the form itself right at the beginning. Data-driven reporting format, high-level summaries and just reporting the transactions will not do. There has to be data which will have to back up each and every transaction, and how the overall scope in terms of reporting has gone up, which we will look in a detailed manner. Fast track APS for IT companies, which Sunil also reflected upon, is quite a game changer because the average period has been significantly promised to be brought down to 24 months, which used to take 3 to 4 years, and a penalty rationalization for non-filing of Form 3CB are some of the other changes which were announced during the budget. Next slide, please. So safe harbor rules, I think while safe harbor has been around for a lot of time, there were some grievances which the taxpayers faced with them, and because of which it had not become significantly popular. I think two of them were, one is the threshold, which was being applied for, and it was majorly looked at for being applied to smaller and mid-sized companies, because once a company grows its turnover in India, they would mostly fall out of the threshold which was prescribed for the safe harbor regime. And I think this has been addressed in terms of the budget announcement, specifically for IT services category. And I think second, which most of our clients also used to state while we would discuss as one of the options of safe harbor when they were facing continuous litigation, was that the margin expectation by the government was significantly high and was not relooked upon for many years. It was stagnant, the margins which were prescribed, and every year there was a hope that some of these margins would be relooked into. And because of, I think, the new rules and the act coming in, they have rationalized the margin significantly, which we will look at in the later parts of this slide. But just a quick summary of what is the safe harbor rules key reforms. So like we mentioned, there were multiple categories for IT services, such as IT, ITes, BPO, KPO, and contract R&D, which has been clubbed into a singular bracket called information technology services. And each of these category had its own definition, own threshold, and own margins. While the definitions still continue as part of the new rules, the margins have been rationalized and brought down under a single category. Every year there was an annual extension. So first, during the budget, the extension of the safe harbor rules would generally be announced, and post that, clients would have to make a decision whether they would still stay with the safe harbor rule or come out of it. Now a block period concept has been introduced for IT services, whereas you can opt for safe harbor regime and you get a safe harbor clarity for over 5 years, which becomes a very critical aspect for those seeking clarity in India, so that every year you don't have to wait for the budget to decide whether you will stay with the safe harbor rules. You can automatically apply for it for 5 years. Complex procedures, manual filings, and potential scrutiny. So you had to manually file these forms. Sometimes the AO would or the transfer pricing officer would pick up these forms and ask for further details. Now it has been proposed that it will be a one-time evaluation for IT services in the first year, and post that evaluation, if the profile and the margins are being met upon, then there will be no questioning over the next 4 years. And limited expansion, which was there in terms of the transactions which are eligible for safe harbor. But now I think we are getting a feeling that wherever the government is trying to push for certain businesses or certain industries to set up in India, they are also giving some tax breaks around it and trying to provide clarity by also including them in the safe harbor regime. So we will also look at this in a much more detailed manner. Next slide, please. So, like we mentioned, there were four categories earlier which were eligible for the safe harbor regime. That is software development service, ITES, that is IT enabled service, knowledge process outsourcing, and contract R&D related to software development. and each of them had their own threshold and margins. Now all of them have been consolidated under one bracket called information technology services. And this is especially helpful for companies who were providing one or multiple services. So say for example, a company is providing both software development and say KPO. Now both of them had different margins which used to affect their reporting, and they had to prepare detailed segmental data. And a lot of times this would be questioned by the tax authorities by stating that you are trying to deliberately push the cost to a category which has lower margins. But now by classifying all these services into one category and one margin has been prescribed, that is 15.5%. So what it happens is, as long as you're providing services under the same bracket of IT services, they will be the ask will be of providing the same margin, and the earlier litigation which used to happen around classification of services, cost allocation, these are expected to bring to be brought down significantly for those companies who provide IT services. And also it sort of gives an option that most of these services, since they are under the safe harbor category, it will bring in more clarity, and hopefully it will also encourage ease of doing business in India. Now, what is the eligibility? While on a high level basis, the reduced margin does sound very attractive, a key consideration has to be given as to who is actually eligible for safe harbor regime. So there are various categories which are prescribed, which means that only if you meet these categories, you get to be eligible for the safe harbor regime. Now, the first condition is that the foreign principal has to control the strategy, design, and key function, while the Indian entity only executes the assigned activity. So basically, the activities to be undertaken, their conceptualization and design has to happen by the foreign parent, and the Indian entity will only execute based upon the instructions which are provided to them. So the place where Indian entity tries to conceptualize or design any of these services, they may be out of the safe harbor regime. Now, in terms of funding, it is stated that all the capital, the assets, and intangibles have to be provided by the foreign principal, whereas the Indian entity only gets a remuneration on a cost plus basis. Meaning that if there is, say, some intangible to be used while providing these services, these have to be owned by the foreign parent, and these cannot be developed onshore in India, which also is a critical aspect for all those companies who are trying to be part of either developing the intangible partly in India or wholly in India, and are looking for a safe harbor regime. They will have to carefully look at whether they will be still eligible for the same. And the most critical condition where I think a lot of litigation used to happen is that the Indian entity should bear no significant risk and hold no ownership over intangibles which are being developed. So I think this is one of the key criteria where a lot of times the safe harbor would be rejected, stating that the Indian entity is bearing much more significant risk than it is required to, or is part of some intangibles which are being developed, which would not be eligible, which would not make it eligible for the safe harbor regime. Now, in terms of margin, it used to vary between 17 to 24%, whereas say ITes service would be at the lower end of 17%, and contract R&D and KPO services would be at times a margin of, the expected margin would be around 24%. All this have been drastically reduced to 15.5%, meaning that somebody providing KPO services or contract R&D and who were earlier expected to offer 24% to be eligible for the safe harbor regime, they almost get a reduction of 9% in terms of the margins expected. So this will be a significant boost and savings for all those companies who maybe earlier were not so keen to go for safe harbor regime. Now they should carefully evaluate with the reduced margin expectation. One more aspect was the eligibility threshold. So the eligibility threshold was around 300 crores for most of these services, and earlier it used to be 200 crores, which was recently increased to 300 crores. But I think one of the feedback which the government received was that 300 crores in today's day and age, where there is mostly over foreign exchange billing, is not sufficient for companies who have developed a lot of services in India. And this 300 crore threshold would be met a lot of the times for companies who are based in India for 5 to 10 years. And they then would have to compulsorily look at APA as an option to get tax certainty in terms of their transfer pricing regulations. So by increasing this threshold to now 2000 crores, a lot of companies, a lot of mid-sized and smaller companies who are just starting out or were providing services, they now become eligible for the safe harbor regime because of the increase in threshold to 2000 crores. So these were the major changes in relation to IT services. One more new category which has been added for the safe harbor regime is data center services. So I think during the budget also this was a major announcement whereby the government said that it is looking at a lot of foreign companies to set up data service centers in India. And also an exemption was provided to the foreign taxpayer by stating that if you are using data center services in India and providing services to overseas customers, all those amounts which are earned by the foreign company, they are out of the tax net in India. So a lot of clarity was given to the foreign taxpayers by stating that their income will not be taxed in India. And similarly, if the foreign company is using its associate company or subsidiary to set up a data center in India, then the services which are provided by the Indian subsidiary, they will be eligible now for a safe harbor which will be applicable to them. So the data center services have been defined by mentioning that the components include land, buildings, mechanical, electrical, power equipments, which are generally part of a data center service. And a very reduced margin has been offered of cost plus 15%. So I think a significant boost has been given to data center services by also sort of enrolling them under the safe harbor regime. Next slide, please. So the process and compliances have also gone a significant change for the safe harbor regime, which I request my colleague Priyanka to explain. Sorry, Priyanka, I think you're on mute.
Am I audible now?
Yes.
Yeah. So thank you, Ashwath. Let's discuss about the compliance and process requirement under Form 49, specifically for IT related safe harbor provisions. Form 49 is essentially a one-time option exercised by eligible taxpayer opt into safe harbor regime for a block of 5 years. So once opted, it brings consistency, but it also requires ongoing strict compliance. The application needs to be filed with the DGIT system before the due date of the return. It has to be certified by the CEO or managing director of the company. Once the form is filed, the next stage is electronic verification. The authority will evaluate three key aspects: whether the assessee is eligible, as just discussed by the Ashwath also, that for eligibility, assessee has to provide the low-end back office support services rather than a foreign principal who is undertaking the major function and assuming the major risk. So your fire analysis in the TP documentation clearly reflect the characterization of the assessee in line with the safe harbor rules. Then the eligibility of the international transactions. So the transactions which are covered in safe harbor regime, we will check this aspect also. Then further, the exercise of option, whether the assessee has validly exercised the option or not. So this step basically ensures that only genuine and compliant taxpayer enter the safe harbor regime. After verification of the application, the DGIT system has to communicate his acceptance or rejections, and it has to be done within the 2 months from the end of the month in which Form 49 is filed. In case the DGIT system, the designated authority, is not accepting it or rejecting it, then it has to communicate the reason, and opportunity of being heard should be provided to the assessee. Then once the approval is given to the assessee, the tax officer is required to comply with certain statutory requirements. So even if the assessee has opted for safe harbor regime, still he has to comply with Form 48 as well as the TP documentation. So even if you are opting for safe harbor regime, there is no waiver from the TP compliance. Even then, TP documentation is required to be maintained. Then the next thing is the assessee has to file his ITR before the due date of the return. In case these conditions are not met, then the safe harbor will remain inoperative. So Form 49 is a one-time application, but for the rest of the year from 2 to 5, the assessee is required to file an annual statement, just giving the just giving the information related to eligibility of eligible transactions, quantum, and profit margin for each year. Now, one major thing is the assessee can also opt out of the safe harbor regime within the 6 months from the end of the first tax year. He can do that provided a declaration is made in this regard, and there is a condition that once the withdrawal has been done, he cannot re-enter into the regime for the original 5-year period. Moving to the next slide. Okay. Now, let's compare it with the earlier framework under Form 3CEFA. Understand the strategic shift in the compliance process. Under the earlier rules, the safe harbor was filed with the jurisdictional officer. However, under the new regime, there is a shift in filing authority specifically for IT services, that is DGIT system, while the other transactions are continued to be handled by the assessing officer. This change introduced greater specialization and centralized handling of the IT-related cases. So the coverage of the transactions, transactions are same. Only the IT category is consolidated, as Ashwath has discussed in detail. Then mode of verification. This is another important change. This simplifies the mode of verification is now, it is largely earlier it was largely driven by the assessing officer or transfer pricing officer. So there was a lot of manual intervention on scrutiny. But in contrast, the new framework introduces electronic filing and verification through DGIT system. This reduces physical interface, enhances transparency, and ensure faster processing of application. From Okay, then we move to practical impact. Earlier, this exercise has to be undertaken each year. Each year, Form 3CEFA was required to be filed, and the intervention with the assessing officer was required. But now, with the introduction of block year concept, this is being streamlined, and only one-time interface and the verification process will be done by the DGIT system for the assessing officer. So this has also standardized the form and the procedure. Earlier, the due date for filing the safe harbor form was before the due date of ITR return. It has to be filed before the due date of ITR return. But now, for IT services, for other than IT services, the form 49 has to be filed before the due date of filing of ITR. However, ITR should be filed before Form 49 because Form 49 clearly mandates to write the date of filing of return of income. For IT services, it doesn't ask for the date of the ITR, so you can file the Form 49 anytime before the due date of filing of ITR. Moving to the next slide. Now, Ashwath will discuss the impact analysis of the safe harbor to the IT services and data center services.
Sure. Thanks, Priyanka, for taking us through the process involved. Like we have discussed, I think it is very visible that by increasing the threshold above 300 crores to 2,000 crores, a lot of companies now can look at the safe harbor regime itself if they are eligible, rather than going through the detailed process of going for an APA. The second thing is that there is only one-time evaluation of the turnover threshold. So under the rules, they have mentioned that the 2,000 crore turnover threshold, which has been specified, is only to be evaluated in the first year. Meaning that if in the second year, suppose the taxpayer exceeds that turnover of 2,000 crores, then they will still be eligible for the safe harbor regime over the next 4 years. So this also provides significant clarity, and there is no ambiguity by stating that what if the taxpayer exceeds this 2,000 crore threshold during the block period, they will still be continue to be eligible for the safe harbor regime. Obviously, this reduces the compliance burden and litigation cost to the taxpayer. So every year, rather than going through the detailed process of going through assessments and benchmarking and trying to litigate with the officers, I think those companies whose profile matches the safe harbor requirements can certainly look at opting for the safe harbor regime, since they will get a clarity and a fixed margin of 15.5% for a period of 5 years. But while all the announcements on a threshold looks very attractive, a deep implementation assessment has to be done to ensure that whatever are the eligibility criteria, they will still be met. because we have seen in a lot of cases there is a minute evaluation of whether each of the criteria is being individually met, and only after this minute evaluation is the safe harbor regime granted. And also the taxpayers have to think about that this is a block period assessment now. It is not that every year they can opt in and opt out of the safe harbor regime, meaning that once you opt for the safe harbor regime in the first year, it will still continue to apply for the next 4 years. And like Priyanka also mentioned, that the option to withdraw from the safe harbor regime only appears to be available till the second year. So post that in year 3, 4, or 5, there is no specific option which has been provided to withdraw from the safe harbor regime. So if there is a change in terms of the margin expectation, and I think because of the impact of AI, a lot of companies, their margins could also get affected in the long term future. And also, if there is a change in the profile, which is expected to be done in the company's profile over the next few years, then they have to critically evaluate whether they are okay to go for a 5 year block period by opting for the safe harbor regime. And I think the impact on the GCCs, like Sunil sort of mentioned earlier as part of his presentation, that the innovation centers and the companies who undertake a cutting edge technology or are a key part of the IP development. And in fact, there have been a lot of press reports and news articles stating that the employees of the GCCs in India are not only looking at sort of doing back office operations, but also are taking up global leadership roles. So if these are the criteria where there is cutting edge technology or IP being developed, or employees who entirely take over the function and are not looking at receiving instructions from their foreign parent, such companies may not be eligible for the safe harbor regime. So I think for the GCCs, there could have been some carve out which could have been done as part of the safe harbor regime, because the thinking in a lot of GCCs today is to take a lot of the global functions in India and not just do back office operations. So I think for them, still the safe harbor regime may not be easily applicable, and they may still have to look at APAs to get clarity. But those companies who do limited functions and have no part in sort of IP development or sort of registering the IP in India, the safe harbor regime does make a lot of sense. And like we mentioned, another introduction is the 15% safe harbor for data center services. So I think companies who want to be part of the larger ecosystem of developing data centers in India, they can also look at getting some clarity through the safe harbor regime. Next slide, please. So like we have mentioned, the erstwhile Form 3CB has been significantly overhauled, and a new form has been introduced as Form 48. Now, while the earlier requirements were just doing a high-level reporting and taking a declaration from the auditor that in his opinion, the transactions met the ALP standard, this used to be the expectations which were set as part of the Form 3CB, and a lot of granular details used to be just kept as part of the TP study and not be disclosed in the Form 3CB itself. And I think the change has been to from the IT department's perspective, that it is not only during the scrutiny or the assessment process that these details should be evaluated, and the taxpayer has to voluntarily disclose these details. So from a more high level reporting which the taxpayer used to do, I think the mandate is clear in Form 48 that there has to be voluntary reporting of each and every transaction on a detailed basis as to whether a benchmark has been set for the same and how this benchmark has been arrived upon to justify the ALP transaction. So we can look at the key regulatory milestones only from a documentation perspective. So like we looked at earlier, the transfer pricing regulations were introduced in the year 2001, and in the year 2002, the Form 3CB was introduced. And from a documentation perspective, there was not a lot of change for over 2 decades. And only in 2016, when the OECD BEPS action plans were introduced, the master file and CBCR were also notified as part of the income tax rules and in the Income Tax Act. While the application was only limited to large taxpayers because there were thresholds which were mentioned, master file and CBCR was not applicable to all the taxpayers, and this was more centered around global reporting rather than the local file where there was no significant change. And I think post the 2016 introduction, after a decade, there has been introduction of Form 48, which will significantly increase the compliance liability, and also a deep look has to be done in terms of the transactional reporting. Next slide, please. So when we were looking at the draft form, we were quite surprised as to the level of transactions which are being asked for, and then we thought why this could be done. So these are some of the reasons which we feel has been the reason for the significant overall. Uh, the first reason is 20 years of stagnation. So I think there has been no change which has been done, and in terms of the scrutiny or the litigation in the transfer pricing regulations, it has gone up significantly. And so one of the realizations from the government would have been that while there are a lot of transactions which are undertaken, these are not properly reported as part of the Form 3CB itself. So I think because of that reason, there has been a significant overhaul to bring in enhanced transparency so that detailed information on each and every transaction and the linkage between the transaction and its associated enterprise, and whether a margin is being charged, and if yes, what is the margin, has been tried to be sort of achieved by doing these changes. Narrative based reporting. So the reporting earlier used to just focus on descriptive disclosures instead of a structured or database reporting. So it just report the transaction and the method by which the transaction was benchmarked, but the actual results of the benchmarking would be generally a part of the TP study itself. So I think an attempt has been made to bring these benchmarking data right in the form, so that there is improved risk assessment, so that it is not only when the assessment is opened, but right in the form itself, the taxpayer makes a disclosure as to how he has benchmarked this transaction and how he is believing that the transaction meets the ALP standard. This has to be reported now in the form itself rather than just being captured in the TP study. The dependence on the TP documentation used to be significant. So a lot of details would be covered as part of the TP study. And interestingly, the TP study would not be uploaded as part of the Form 3CB, just the high level reporting would be done. And the TP study would only be obtained if there is an assessment which would be opened. So I think a lot of clients or taxpayers who used to look at TP study as a post assessment procedure have to carefully evaluate how they will maintain the TP study, because that will be a significant bedrock as to how the transactions will be supported, which are being reported in the new Form 48. And this will align us with the global requirements. I think a lot of countries already do this as part of their transfer pricing reporting in the local file, and we are simply aligning with the OECD BEPS standards to keep in sync with the global tax norms. Next slide, please. So we'll look at the Form 48 in a much more detailed manner by doing a structural deep dive, which I request my colleague Priyanka to take over.
So let's discuss the structure of Form 48. This is not just a format change, it represents a clear shift in how transfer pricing compliance is expected to be demonstrated, especially from a compliance and risk management perspective. Let's discuss part-wise changes, how it is going to impact you and how it is going to capture the details. First is part A, particulars of the assessee. There are no structural changes to it. It is largely in line with the Form 3CEB. Then part B. There you can see, you will see that there are changes. Earlier, only aggregate amount of transaction as per books of account was required to be reported. Now there are three categories: uh, international transaction, book value of international transaction, book value of specified domestic transaction, as well as the new category has been added, book value of the deemed international transaction. Apart from these three categories, they will also ask whether the transaction is received receivable or paid payable. Earlier, it was not there. So it will ensure, that reconciliation with the financial statement also. We'll just show how they are asking the information in the next slide. Then part C, details of international transaction, including deemed international transaction. Earlier Form 3CEB disclosures were required more at high level basis. Form 3CEB allowed for clause-based disclosure, which gives some flexibility in the presentation. But now the focus has moved from aggregated disclosure to the transaction level scrutiny, or I would say granular details of the transaction would be required. So each item has to be independently evaluated and substantiated. We will discuss this. We have already discussed this in high level manner, but we will discuss this in detail in the subsequent slides, what all information the form is required now. Then detail of IDT. there are no major changes in the SDT, sorry, specified domestic transaction. SDT reporting with ID driven mechanism. Yes, I would like to mention here that now ID driven reporting mechanism is a notable procedure upgrade. Whenever we report a transaction, a unique ID will be generated and used as a reference. The change becomes even more significant. Sorry, so it will be used as a reference. So this is a move towards system based tracking and analytics by tax authorities. Then determination of arm's length price. So earlier in form 3CB, only the method of benchmarking the transaction as well as the amount of arm's length price of value of transaction is required. But now they are also asking about what method you have selected, what is the range, what is the outcome of your benchmarking analysis. So this is just like a mini TP report. Then Part F, documentation to be open only if the aggregate value of transactions. So there is a new Part F, that is documentation. So this will be open only when the transaction exceeds the 1 crore limit. So if the international value of transaction exceed 1 crore, then only you have to explicitly mention whether the TP documentation has been maintained or not, or whether the conditions satisfied for the maintaining of the TP documentation. Moving to the next slide. Yeah. So what we were discussing in part B, earlier in form 3CEB, there were two different pointers: aggregate value of international transaction as per books of account, aggregate value of specified SDT as per books of account. But now there are three categories, and in those three categories also there are subcategories, whether so amount of receivable, payable for all the categories. Then moving into the next slides. So here what we were discussing in part C, earlier the transaction, there were different clauses. Like if you see here, particulars in respect of providing of services. So there were earlier other clauses like intangible properties, purchase of traded goods, sale goods. So different clauses were there. But now all the transactions are required to be reported in this part only, and it will be auto populated from the part E, where the complete data analytic will be required. Moving to the next slide. So let's discuss about the major changes in detail. This slide focuses on one of the most critical sections of the new form 48. Unlike the form 3CB, this section significantly deepens the level of details required. Starting with the transaction level reporting, the emphasis is clearly on granularity and traceability. Each transaction must have unique transaction ID, as we have already discussed, and this will ensure that complete traceability across the different categories and subcategories for basically this is for the tax officer. Then details of the sensitive transactions, as Sunil also mentioned in his opening remarks, that now the rate of the royalty, rate and terms and condition of certain financial agreements and guarantee agreements are also required. So this is a very significant change, because you have to revisit your agreements so that the clear rate and amount can be specified. Then in the case of details of agreement with respect to restructuring and organization, earlier only the nature of the transactions were specifically asked, and these details were not captured. But now the terms and condition, date of the restructuring agreement is also required to be captured. Then Determination of arm's length price. I think this, as we discussed, is a new introduction in the Form 3 CEB Part E. This is a core analytical section where the actual ALP determination is presented. Taxpayer must disclose aggregate whether he has adopted aggregated approach or benchmark the transaction individually. There is a mandatory disclosure of the TP method, number of the comparable used to determine whether arm's length range or mean or arm's length price, whatever is applicable. So a detail, it is, as we mentioned, this is just a mini TP study report. So whatever we were, so every time we say that TP study is required at the later stage, no, it is required before the filing of Form 48. It is now, it has to be, it is now an exercise which needs to be completed before the signing financial statement as well. Then there are certain additional details which were never asked before. They were never asked before. Uh, these are expense categories. This focus on cost transparencies. Taxpayer must disclose whether certain costs are recorded or not recorded in books, and whether they are included or excluded in ALP computation. These specific coverage includes ESOP cost, such as ESOP cost borne by the AEs, employer-related cost, maybe any expense related to travel, training, or even the assets which are being provided by the AEs. So all the cost you have to mention whether these has been taken into consideration when computing the cost markup. This was not required, only required at the time of assessment. So this is very, very important. This was not even going into your TP documentation before. Only were asked at the time of assessment. Moving to the next slide. Now, there were additional details regarding to revenue category. So just like expense category, they are asking from the point of view of income category also, because there are certain different views of the tax officer whether the foreign exchange fluctuation is operating or non-operating. So they are now explicitly asking. So those income which are related to your operations of the assessee company, then they have to mention here whether these have been included or excluded from the computation of ALP. So accordingly, tax officer will analyze whether it has to be included or not included. Then these were the important changes, I think, which we have touched upon, like determination of ALP, additional details which were not required before, but now you can see Form 48 is not just a reporting form anymore. It is becoming a self-contained TP assessment document. In essence, it shifts narrative from filing a form to defending your transfer pricing position upfront, making compliance more rigorous, data intensive, and operationally challenging. Then after this, there is one more change I would like to highlight is APA reporting. So for those transactions where the assessee has entered into an APA agreement, they have to mention the details of those agreement, acknowledgement number, and the date of details of the covered transaction, and the value for the relevant tax year. Moving to the next slide. Now, this is basically so here we have fixed a screenshot of the additional information which we have already discussed. Like now they will ask you whether you have aggregated the disclosure or not, and if the if the transaction is individually benchmarked or closely linked transaction, then you have to mention the method, 35th or and then what are the number of comparable count, 35th or 65th percentile, and what is the amount of what is the and the mechanism of determination of arm's length price. The amount of arm's length price, how it has to be defined, is also being formed part of the notes to Form 48. So we have to be very cautious while determining the amount of how we will determine the amount of value of how we will determine the value, arm's length value of the transaction. Now, next slide. Now Ashwath will discuss how this is going to impact on how the change in reporting format is going to impact on the taxpayers.
Thanks, Priyanka, for taking us through the changes in the form. And I think, like we have seen through the requirements, definitely there is a sea change in terms of the compliance reporting which is required to be done as part of the annual reporting which we do to the government. So obviously, because of the increased disclosure requirements, the reporting burden will certainly increase. So there is granular disclosure of both international and domestic transactions and mandatory reporting of royalty arrangement, financing transactions, and details of intercompany agreements have to be provided. So in case if there is a lack of agreement, which we have seen in some cases because these transactions used to be aggregated and only the entity level margin would be considered. So in such cases, if it is being aggregated, a separate approach may have to be considered, or at least a proper agreement has to be placed so as to justify this transaction, and these cannot be merely now hidden under the aggregated approach. Shift to real-time TP management, which my colleague Priyanka also alluded to, that TP compliance is not no longer a year-end exercise where you sit in September or October and decide what is the reporting to be done, because there has to be real-time tracking and documentation of intercompany transaction, because each transaction now first has to be disclosed, second has to be justified as to what is the approach by which we are sort of justifying the ALP of the transaction, how the comparable study has been done, how the comparables have been picked, what is the method. So all of these details have to be now placed right in the form by October. So this is no longer a thing which can be done once the assessment process starts. This has to be done right at the beginning in terms of the compliance itself. Greater risk exposure and need for strategic planning. Like we have mentioned, some of the transactions which were not expected to be reported earlier now will become available to the tax authority. And if their expectation and the documentation do not match, then these will also lead to a greater risk exposure. So some of the cases or some of the taxpayers who may not have been picked up earlier because their entity level margins would be comfortable now may be picked up for assessments because of the increased reporting in the form. And like we mentioned, because of this increased reporting, the assessment and litigation risk definitely goes up. So any inconsistency between the Form 48 TP study, intercompany agreements, and the financial statements will likely be flagged off. So we have to remember that the government gets a lot of data across various different sources. There is also international reporting through the disclosure agreements which are there in place, and through the CBCR and master file reporting also. There is a lot of data which is being flown to the government through the foreign governments and foreign authorities. And in addition to this, there is also a highlighted requirement to disclose more transactions in the form itself. So I think definitely this will lead to higher data availability with the government, which may increase the risk profile of a lot of taxpayers. Reduce scope for post facto corrections or explanations. So a lot of time what we would see is the TP report would be filed in the form 3CB. The TP study would be prepared much later. And when the assessment comes up, a lot of soul searching would be done to justify this transaction. Now we are feeling that may not be possible anymore because the taxpayer would voluntarily offer a lot of information right in the beginning, and at the time of assessment, if he differs from this information, then the tax authority may ask the justification for the same. So I think there has to be live tracking of the transaction. The moment there is some planning to be done, right at the beginning, a thought process has to be evaluated as to how to justify this transaction, what is the margin which we will set, and how do we justify the margin, by which method, and what is the benchmarking to be done. And this definitely necessitates a high degree of vigilation and preparedness, both for the Indian taxpayer and their foreign associates. Because wherever we are seeing a mirror filing or a Form 3CB, which is done by the foreign AE, they also have to carefully evaluate as to how they will report these transactions in Form 48, because they cannot simply rely upon the Indian domestic taxpayer to do all the reporting. It has to be matched with the foreign taxpayers profile also. So I think a lot of increased information definitely will be asked, and there has to be some real time thinking and a strategic shift as to how to justify these transactions in the form itself, rather than just waiting for assessment to be picked up and just hoping that the tax authority does not ask for these details. Uh, Next slide, please. So there are some other other changes which have been announced during the budget process. So I request my colleague Priyanka to quickly explain the other changes.
So, we have already discussed one of the most notable changes is in the introduction of a fast-track unilateral APA process, specifically for the IT sector. This is a significant step considering the high volume of IT transactions. The objective is to simplify and accelerate AP resolution. So those companies, those assessees who are not able to avail the benefit of safe harbor due to the thresholds or they are not meeting the profiling of the eligible assessee as defined in safe harbor rule. So then they can avail the APA benefit. In essence, the APA regime is evolving from lengthy negotiation process to a more streamlined and time-bound certainty mechanism. So there will be upfront clarity and quicker resolution. There is now a clear timeline commitment from the tax authorities. APS in the IT sector are now expected to be concluded within 2 years, which earlier were taking 4 years, 5 years. And an additional 6-month extension will also be available at the taxpayer's option. So I think this is a biggest boon to the IT sector companies, and they should enter APAs to avail this benefit and reduce litigations in the future. Then the changes in the penalty. Earlier penalties have been now. So earlier the penalty was 1 lakh, and that was at the discretion of the assessing officer. But now it is automatic. Once you are delayed in filing the Form 3CEB or Form 48, Form 3CEB, then there was 1 lakh penalty was levied. But now it will be only levied. It will be levied at the time of submission of form. For delay less than 1 month, it will be 50,000, and for delay beyond 1 month, it is 1 lakh. So now we can take up the questions.
Shweta,
So
are there any
there are,
questions?
yeah.
Should I read the question?
Yeah, go ahead.
So, Rajesh Prabhu have asked, are there rules around what eligibility cost for 15.5%?
Ashwa, do you want to answer that?
Yes.
The eligibility
Yeah.
around
So
the
that is
15.5%. Yeah, I think we discussed it.
Yeah. So for 15.5%, there are eligible costs. So in the definition earlier as well for safe harbor regime, there were certain costs which were included and excluded as part of the cost base. Now, in terms of the definition of cost base, it has not gone a change in the new rules as well. The same definition applies. So, for instance, ESOP costs are to be added as part of the cost base. Foreign exchange losses will be excluded as part of the cost base. So, like this, there are additions and deletions which are to be made to the cost base, which has been already notified earlier, and the same applies now as well.
Okay, there is another question asked by Mr. Sandeep. If TP study details incorporated in 3CEB form, we will have a challenge in comparative study since financial will not be available. This will be a challenge for taxpayer.
So I completely agree with that concern. If detailed TP study elements start getting embedded within the Form 48, or it could create practical challenges, especially around comparative analysis, since contemporaneous financial data of comparable is not often not available at the time of filing. From a practical standpoint, this increases the pressure on taxpayers to finalize their position much earlier, rather than relying on post facto adjustments, as Ashwat just mentioned. So, it is very important for us to educate clients in advance on maintaining robust and contemporaneous documentation, ensuring timely availability of data, and avoiding last minute changes or adjustments, which I think which may be difficult to justify before the tax officer in the later stage.
But just to add to this answer, I think there is not much change in the overall approach. So today we choose to prepare, or we may choose to prepare the transfer pricing documentation later, but the law still says that we have to use contemporaneous information in order to prepare the benchmarking analysis, right? So even if you choose to prepare the transfer pricing documentation at the time of assessment, you are still using the data which existed as on the date you closed the Form 3CB, right? And then the tax officer has an opportunity to update that data at that stage. So today, all we are doing is we are trying to document what is available today. The only difference is it was not visible to the tax officer before, but it will be visible to the tax officer now under the new reporting norms.
We also have one more question. What exactly does it mean by execution to be done in India and R&D in foreign countries? What classifies as execution?
So yeah, I think by execution to be done in India, we mean that certain services which has been agreed upon as part of the intercompany agreement, they have to be done in India, and there are strict guidelines around it. So basically, the idea of a safe harbor regime is that the services are say not prone to risk taking. These are services which are instructed upon by the parent, and in terms of the conceptualization, design and the instructions, these are to be done by the foreign parent, and in India only execution of certain tasks are to be done which are risk free, and for that you get a cost plus margin for it. So it will differ on a case to case basis as to what will be exactly meant by execution, but the overall idea is that in terms of conceptualization and the IP development, those responsibilities are to be taken over by the foreign parent, and only instruction based work is to be done in India.
The brain of the development is sitting outside of India, and the execution, only the execution based on the instructions given by that brain is done in India. That's how it is always seen. That's how it is. That's how you draw a line between who is doing the execution and who is actually a developer of a particular technology or any solution.
Thank you, Sunil. There is one last question. Appli- app- Applicability shall be from tax year 26-27, right? ALP would not be applicable if SH is chosen, right? I mean, right
Yes,
is a
so
question mark.
yeah, the applicability of the new rules will be from the next financial year. So the reporting will be in the year 2027 in terms of the reporting. But the safe harbor regime, which will be applicable, that can be planned from the next financial year itself. So that has to be carefully evaluated right away as to whether for an IT company, whether they would be choosing to apply for the safe harbor regime and then relook at the margins which are being earned in India. In terms of ALP, because there is a specific margin which has been announced. So yes, if you are say applying for the safe harbor regime and you get approved, as in your application gets approved, then a fixed margin as notified by the government will apply. But in terms of reporting, the Form 48 and TP documentation will still have to be maintained, because in the rules it specifically provides that these requirements of the Act will still be applicable and these will not go away. So yes, in terms of margin clarity, there is clarity which is available of 15.5%. So you don't have to sit and benchmark the cost every year. But in terms of compliance, the requirements will still apply.
Thank you, Ashwat. With this, to the end of the session. So thank you everyone for joining us today. We hope you found this session insightful and practical. If you have any further question, please feel free to reach out to us. Have a great day ahead. Thank you.
Thank you.